welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, we welcome Jack Farley of the Forward Guidance Podcast. Jack, thanks for joining us.
Nick, it's my pleasure. Thanks for having me.
So I want our audience to know that I am a regular listener of Forward Guidance. And in particular, I love the episodes in which Jack brings on guests that are focused on interest rates, fixed income, money markets, global macroeconomics. And he does a lot of that. I've mentioned several times in my letter, as well as this channel, the episode he did recently with Russell Napier. I've discussed episodes that he's done with Michael Howell and Joseph Wang. And those are some of the episodes that I've repeated actually this year. So, Jack, I appreciate your work. Today, I want to discuss with you your favorite reads in the world of global macroeconomics and finance. So let's start with one of your favorite books here.
All right. So it's number one, it's hard to choose. It's like picking children. In fact, when you mentioned Joseph Wang, I said, oh my God, in my list that I prepared, I didn't even pick Central Banking 101 by Joseph Wang, which is an incredible book. And it's accessible to people if they want to learn about the plumbing of financial markets, but it also is pretty deep. It's not like preschool. It's gonna take you and learn you a lot. But it's more of a textbook style rather than narrative driven. But here's the book. So I'd say number one is Lords of Finance by a guy, his name I have a hard time pronouncing, Liaquat Ahamed or something. It basically is about the bankers that broke the world. Number one, have you read it?
Yes, I have.
Okay, that's great. Not surprised to hear that, but that's great. So it's about four central bankers in the 1920s: Benjamin Strong of the Federal Reserve, Montague Norman of the Bank of England, something Marat of France, and then Hjalmar Schacht of the Reichsbank, the German bank. And basically, World War I, tons of money printing, tons of debt creation, and okay, the war's over. That's great. The suffering is over, but we've got to recreate the global monetary system and reimpose the gold standard, which was working very well from 1870s to 1914. It paused in World War I, and spoiler alert, it ends in the Great Depression and the stock market crash from 1929. But yeah, it's a fantastic book that is both so interesting and rich in human emotional detail as well as the plumbing of the financial system, which is pretty rare to get in both. So that I'd have to say that's pretty close to number one.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. And let me ask you about that book specifically. Tell the audience about the relationship between Benjamin Strong and Norman across the pond. These were the heads of the central banks in the respective countries. Talk to us about the relationship. What was special there for the greater impact on the financial system?
They were very chummy, and in the letters that the author reviews, they are speaking to each other as if they were pretty much best friends, which is pretty strange. Like, it's not like the CEO of Microsoft is best friends with the CEO of Apple. They know each other and go around in social circles, but they're competing against each other. And yeah, I don't think that Jerome Powell now has his best friend is running the Bank of England. I think it maybe was a time where people didn't really understand central banking and how important it was. So just the fact that, I can hang out with my other central bankers maybe that was part of it, but yeah, they definitely took a liking to each other, and they had issues, from what I recall from the book and other books about this period, that basically the dollar was too strong, and the dollar was strong enough to be backed by gold because so much gold had flooded into the country, because U.S. was supplying Europe with weapons and ammunition, and gold was flooding out of Europe. So I think by the time the World War One ended, I think like 60 to 70% of all of the world's gold that had been mined was in the U.S. So basically, Europe, which was used to thinking of itself as a rich continent, was had no gold and struggled to go back on the gold standard. And to go back on the gold standard, it'd have to undergo very brutal deflation. And so the British economy was quite weak in some periods during the 1920s. So yeah, that was their relationship. And I think as is common with the Federal Reserve and other foreign central banks, I think the dollar plays an extremely important role, and often other central banks are much more vulnerable than the Federal Reserve, which ultimately can print what is global money, and other banks can't.
And so instead of, I want to just ask you, Jack, do you have any book in your top 5 about the Bank for International Settlements specifically? And if not, talk to us about the role of the BIS in today's world, how you view the BIS. And it's something that I know that you probably read papers from the BIS. We understand that it's a coordination mechanism. But when you talk about Benjamin Strong and Norman from the Bank of England, I think about the founding of the BIS in the 30s and how Norman was really the architect in many ways of the coordination between central banks. So I'm wondering your thoughts about Basel.
Um, so that's really interesting. So the book actually, I think, maybe mentions that at the end. I think the Bank for International Settlements, I do read some of their papers there. Like the IMF, they've got great research staff. I don't think that they have the like plumbing tools that maybe I once thought that they had, or maybe they're pretty rusty pipes. Like I don't think that if the Federal Reserve wants to extend a dollar swap line to the Bank of England, I'm sure the BIS organizes like the Zoom call, organizes the huddle. But in terms of who actually has the power, like I think it is the Federal Reserve. Like in the same way, and maybe some listeners can experience this about people reading about how the Federal Reserve is privately owned and how people can own stock in the Federal Reserve. Like I think that it's technically true, but I looked into it, and basically they're paid. JP Morgan, all a lot of banks own stock in the Federal Reserve, but they're paid a dividend yield that is either zero or what the Treasury yield is. So nothing like no one's getting rich off of owning. There's no conspiracy, And I think with the Bank of International Settlements, I would say it's I think William White, who is a former senior official at the Bank of International Settlements, he said that they kind of have there are a lot of meetings going on. It's about coordinating between the European Central Bank and the Federal Reserve and organizing that collaboration, rather than the Bank for International Settlements like telling. I don't think the Bank for International Settlements tells the Fed what to do in any way. I think it is the Federal Reserve is running the show. That's my perception. Obviously, it's very cordial and stuff, but that's my perception.
Yeah, and I'll just add my 2 cents here as well. When we think about the Bank for International Settlements, it is a coordination mechanism, and it is a bank founded by the central banks themselves. So it's their own mechanism. So it's not like the BIS has the power. The power is with the central banks. The BIS is an assistant to them in order to get things done as they make decisions, either bilaterally or in a Basel meeting or in a Zoom call organized by the BIS. That would be just something I would add there. And on the Fed side, the Fed is founded by bankers that were based in the United States and to some extent in Europe. And so the Fed is a mechanism that was founded by banks to organize a central reserve depository so that they could have interbank settlement, as well as have a coordinated bailout mechanism for when shit hit the fan, like JP Morgan and Citibank came in during the Panic of 1907 and bailed out the financial system. Pre-Federal Reserve, Federal Reserve was in 1913, so the Panic of 1907 did have a lender of last resort. It just happened to be JP Morgan himself instead of the Fed. So they started the Fed in order to institutionalize a mechanism that they already knew they had. So I wanted to add my 2 cents there because it's important when we're talking about financial history to know what the facts are, and it's okay to speculate on who you think is pulling the strings. I would just add that at the end, that we don't know in the end who the ultimate decision makers are, if there's someone in J-Pal's ear or the Fed is whispering to the BIS. So Jack, do you have anything to add there?
Yeah, when I said that the BIS isn't pulling the strings, like, I think it is accurate to say, and I've heard people say that the BIS is the central bank to the central banks, but I don't think it plays that role that the Federal Reserve plays to the U.S. commercial banks. In other words, I don't think that the Federal Reserve has a meaningfully large, I'm sure it's a huge amount, but it's, as a percentage terms, it's not large, percentage amount of its money parked with the IMF. And I don't think that, the Fed, if there's never going to be a run on the Federal, there's never going to be a run on a central bank that the BIS would do. I mean, I guess for currencies, but again, for the Fed, it's not a problem. So I think the analogy is incomplete, because a central bank doesn't have issues that the same issues that a commercial bank has, such as going bankrupt.
Absolutely. So Jack, let's get into your second favorite book on finance.
Okay. I'll pick Debt, the First 5,000 Years by David Graeber. That is just about the history of debt and how it emerged from from cultural reasons, and how people started to a series of promises between people basically started to become money. And basically the theory is, and it's very hard to prove this, but also hard to disprove it, that barter is a myth. Like, it never was, I make 5 shoes and you are fished 5 fish and then we exchange them. It was pretty much, I gave you 5 fish and I gave you 5 shoes, and then you owed me something, and then you gave me back 5 fish. So the transaction was the same, but it really was not an exchange. It was a loan or a gift, which really, if you're from the repo world, that those things are not always so different. Or a loan or a sale, they're pretty similar. And then you would give me back the 5 fish, and then that would be in some unit of account. So that book isn't as fresh in my mind, but it's I mean, really going back to tribes in Africa thousands and thousands of years ago, to Mesopotamia, to the rice and the barley loan, to more modern times, to money lending during the medieval ages, and then, I mean, central banks don't appear until like the second to last chapter. Or I should say, modern, what we consider modern finance doesn't appear until the, I think, penultimate chapter. But it's very, very good. I would recommend it.
So how do you then think about gold as a historic money versus the construct of debt, or IOU, tally marks, and all of that sort? So talk to us about money versus credit and what that book, Debt, the 5,000 Years of Debt, taught you about it.
Well, I think one lesson or one argument coming from out of that book is that debt is money, and that gold was a way to account for those debts, but those debts existed before gold. And basically, so like when I think about this as the U.S. Treasury, the U.S. government owes so much money. Yes, it's true, but also like if it prints a 3 month Treasury bill, that is money. So I think in a sense, debt is money. Do you agree with that?
I do. And that's the whole existence of what a bank balance sheet is. It is to create time. It's to create basically instruments that connect time. And those instruments are money. If we think about a piece of paper that's a Federal Reserve note, it doesn't have a maturity on it.
Mm-hmm.
But any other time deposit, a repo loan has a 1 day maturity on it. The typical Eurodollar deposit had or has a 3 month term. And so money itself today is a version or some instrument that exists on the liability side of a bank's balance sheet. And that liability has a time. So some of it can be overnight, some of it can be 1 week, some of it can be 1 month, 3 months, some of it can be 30 years. And the longer the time, the less it is money. So that means a 30-year Treasury bond is not very money-like. It's actually quite unlike money because of its term and all that go with having a 30-year term. But a 1 month Treasury bill is quite like money. A deposit is a demand deposit, which basically can be exchanged for currency on the spot, is much more like money than a Treasury bill, but actually has more credit risk than the bill itself because it's a bank liability and not the Federal Reserve's liability. So
Right, but I think most people walking around today, probably including you and me, would maybe people consider cash that you hold in your hand more like money, but I think people use bank deposit money more. I think more than cash. I think cash, I'm just looking at like Bank of America usage of debit card, like credit card and debit cards, i.e., things that are on top of the banking system. Money is used much more electronically than it is cash now. Even though when you close your eyes, you picture money. Obviously, you picture a money bag, but I've literally never even seen a money bag. You picture cash, but I think people actually use more and more are debit cards and credit cards and bank wires.
Yes, and people are starting, I think, to understand deposit money is first of all, it is qualitatively different than cash, paper money, but it has been institutionalized to mean cash. Deposits mean cash to the vast majority or to the zeitgeist itself. And that has become institutionalized with the beginning of FDIC insurance all the way till last year's Silicon Valley downfall, in which the FDIC essentially bumped the cap from 250,000 to infinity. So cash and deposits are definitely, they come from different balance sheets. They are alike in many ways, but there are so many nuances there. And it's a big part of what my own book, Layered Money, is about. It's about the fact that money falls into a hierarchy. Jack, have you ever interviewed Professor Perry Merling?
I have,
or
yes.
Zoltan Pozsar?
Not Zoltan,
okay.
But I have Perry, yes.
Okay. So Perry Merling wrote The Inherent Hierarchy of Money, a paper from 2012 that helps to inspire my book, Layered Money, in which I talk about the history of the hierarchy of money. So there's a little bit of a connection there. Jack, what are your thoughts about Perry Merling and in your experience with from interviewing him?
What was interesting to me is that the liabilities of central banks are a lot. It can be a lot of things, but they're either bank reserves, which are the liabilities of central banks, and the assets of commercial banks, or physical cash, which people, you buy a pack of gum with. So it's this huge spectrum of moneyness, of how easy it is to use. I mean, literally, it's impossible to buy a pack of gum with bank reserves, but it's easier to buy with cash, paper money, than it is even like a credit card. I mean, you go sometimes in New York now, they'll say, oh, you get $5 minimum, or even a $10 minimum. And for example, I think one guy I interviewed, Ingo Sauer, is a German economist. He talked about basically in 1923, the Germany hyperinflation, the Reichsbank was printing tons of money, but it was mostly paper money. I think if they had only done like quantitative easing and printed no paper money at all, I assume, maybe incorrectly, but I assume that it must have been much less deflationary. So I've interviewed Perry once or maybe twice, and I've read his new book. I read his new book, and I read his book on Kindleberger, but I actually haven't fully, I think his hierarchy of money was probably in a paper, which I have not read. So educate me. I mean, tell me about that.
Yeah. So his the inherent hierarchy of money is a paper, 2012, and then he wrote a book. The full title, I'm blanking on it, but it's his book on Lombard Street. No, it's the Lombard Street.
Yeah, that's one I haven't read. Yeah.
Yes, and so that is a history of Walter Bagehot and the period of the mid 19th century Bank of England becoming the lender of last resort. It gives that early history and then goes into the history of repo and how repo became a construct. It actually explains how collateralized treasuries were money in the early 20th century. So even if I remember correctly, even before the Federal Reserve existed, or in the very early days of the Fed was engaged in treasury repo right from the beginning. So as a monetary construct, repo has been around for a long time. And my favorite quote from Perry Merling, I use it on a big slide for my students at USC. Repo is how you live to fight another day. That is a Perry Merling golden quote, and it exactly dovetails with something that I learned when I was on the money markets desk, and I met with a repo trader from one of the major Wall Street banks. And at the time, this gentleman who was in Los Angeles visiting us with his sales coverage, they brought the repo trader, which is something that is extremely rare. The repo trader himself is not doing meet and greets with clients on the West Coast. So this was something that was extremely rare for me to get. And I was very early in my career, so I didn't appreciate it at the time. But my sales guy said, you got to learn from this guy. He'll teach you how the bank works. And I understood what repo was, that it was funding for their book, but not as much as I do now, especially that I think about repo essentially every day. It's at the center of my framework. I tell my students, we're going to talk about repo every single class. We're going to build on it from day 1 to day 30, and you'll see the arc on how repo's at the center. So anyway, back to this trader. The trader looked at me and he goes, do you understand repo? And I said, I don't think so. He goes, we're the heart. And he pounds his chest like this. And he goes, we pump blood to the rest of the bank. So we are the center. And I'll never forget that. And that moment that I had with that Wall Street repo trader in Los Angeles underpins the truth of what Perry Merling talks about, which is a hierarchy of money, and how repo is how you live to fight another day. So very important.
Is repo still the way you live to fight another day in the post 2008 world, I imagine, Lehman Brothers, Bear Stearns, every single day they've got to sell their risky assets to get cash in the door and then buy it back the next day. But looking at banks a little bit, as I do, do you think that describes U.S. banks today?
So
As
you
obviously
guys,
repo is still a thing, but as that's how they fight to live another day.
so Jack, you did the episode with Joseph Wang recently in which you talked about rising SOFR volumes and how dealers are reliant on repo to an increasing degree, and the trend is up in that overnight the dealers are using SOFR, and SOFR volume means what? It means GC plus tri-party. You have the individual repo transactions that sum up to that SOFR volume. SOFR is just an index or an aggregate, but what it means is Treasury repo at the core of the dealer system. So in terms of living to fight another day, the entire financial system shuts down if the dealers don't get their $1.8 trillion tonight. And by tonight, I mean it's already passed because we're past the cutoff here today when we're recording. And so at that 11 a.m., 2 p.m., 11 a.m. Pacific, 2 p.m. Eastern, around that window, if the dealers don't have their 1.8 trillion in the door, the whole thing shuts down. And that's what happened on September 17th, 2019. That's why we have the standing repo facility. It's why we have the foreign repo facility, which is a line item that nobody's basically talking about right now, but is growing and is non-zero. And so, yes, the financial system depends on repo to see the next day, categorically based on this one number that is a public daily published number from the New York Fed.
Got it. So that makes sense. What I was saying is that banks aren't relying on repo.
And from a commercial banking perspective, banks have a variety of funding, and they're one of the users of repo in the market. But I'm talking about the dealers that have to take down Treasury auctions by law, because that's what they are legally obligated to do, take their pro rata share of the leftover Treasury auctions that don't get bid in primary, whether by direct or indirect bidders. And so that dealer percentage is what makes Treasury auctions continue to function. That's why we don't have failed Treasury auctions. We just have auctions that went badly because dealers had to take a lot of them.
Yeah.
Those dealers don't have the available cash. They have to fund it from the repo market. Those are money market funds, in large part money market funds that have the cash to fund it, but that cash is overnight cash and can be withdrawn from the system on demand. I mean, basically T+1. And so the relationship between money market funds investing overnight cash to dealers that fund the takedown of Treasury auctions, that is the core of the financial system based on my own experience. And that mechanism is how the financial system itself lives to fight the next day. Not that at any moment the 1.8 trillion could go missing. That's not what I'm suggesting either. But yeah, 100 billion, 200 billion could go missing at any given time and disrupt. So the Fed now has the standing repo facility to protect against that scenario. And they have basically put under the market with that standing repo facility. They learned their lesson in September 2019. If they don't have it, they're going to miss on a crisis that they could have easily prevented with a facility that they now have.
What do you think that the odds of a repo spike crisis a la September 2019 are near zero because of the Fed standing repo facility, or not?
I don't have a great fleshed out take on that. What I would say is that let's see the standing repo facility get exercised in a crisis, and then we can start to judge what it's there for and how it works. And there's just a lot of cash, and so if you have you have a lot of T-bills, so the reason that RRP is going down is that T-bills have a more attractive yield, right? And if T-bills have a more attractive yield and the dealers have all this inventory and they need to fund it and they can't find the money because it's all going to T-bills, they're just going to have to raise the repo rate to attract the money. And that's how money markets work. It's a bunch of asset swaps for the money market fund itself, between bills, between RRP, between tri-party repo, and they're making that arbitrage at all times. There's 6 trillion of that money that's available, so it outweighs the marginal bill auction that could come and settle a new 50 billion in the market today, or even over a given week, you have 100 billion new Treasury securities. We have 6 trillion in money market funds. So they'll find the money somewhere, but rates will have to go up. So what do I watch like religiously is SOFR. And it's the most boring. I don't really tweet about it that often. Who cares if SOFR is going from 5.32 to 5.31 to 5.33 to 5.34 back to 5.32? Nobody cares, but I care because I understand what it means. And so, just to give you background of like why I watch it and how I watch it, I'm just watching repo rates because when I was on the desk, you come in the morning and you ask Citi and you ask the Bank of Montreal and you ask Merrill Lynch, what are you indicating on tri-party Treasury repo today? And
Can I ask what period of time or what year you were doing this?
Yeah, I was between 2013 and 2019. I was adjacent to Wall Street's repo desks.
And was it always like general? It was always repo. So it was never LIBOR. It was never unsecured lending.
So I traded Eurodollar futures, but I was not involved in any unsecured. I bought CDs that were New York CDs. Specifically, the ticker had to be Bank of America NYCD. And those CDs were in my available basket of securities. I was involved I didn't trade it myself, but I was doing true ups and risk.
What's a true up?
Risk.
I don't know what a true up is.
So when if you have a set of securities that you're leveraging, you're borrowing against them in the repo market. So you pledge the securities, you borrow cash, and it's versus 3-month LIBOR. Then when the 3-month term ends, you have a interest that is due, and you have a new amount that you want to borrow because you don't want to pay the loan off, you want to borrow again. So you settle up, and so when I say true up, I just mean I'm going to pay the interest on the loan, take the new loan, and whatever the net balance is, settle that with the counterparty, and then you have a new 3-month term on the loan.
Got it. That makes sense.
So I was involved in 3-month LIBOR floating repo loans, but those were still facing U.S. desks. So I faced London desks when trading in certain SSAs. So these are the supra sovereign agencies, for example, World Bank, IBRD, or European Investment Bank, that type of paper.
What's IBRD?
That is the full name of the World Bank. It's the International Bank of...
the D stands for development.
Reconstruction development. Yes, World Bank is actually the nickname for IBRD, is the full iBird is the ticker, and so we traded that. Traded European Investment Bank, these super sovereign agencies that trade off of a London desk. So I traded those types of instruments, but never euro dollars with a London desk.
Interesting.
Okay, so Jack, let's get into your number 3 book.
So I've got like 10 here. I don't know, just to choose them. Okay, I'd say Reminiscences of a Stock Operator. That's great. By its the fake name Edwin Lefèvre, but it's actually that was the real journalist who wrote a story about a guy called Larry Livingston. Really was Jesse Livermore, who was a Wall Street trader and known for being pretty active on the short side. Who, if you're into trading stories, it's really good. I mean, I can't promise that everything is still going to be up to date. Like he talks about how if something goes, stock goes from 98 to 99 and then it's bust through 100, that's generally bullish because everyone's there. Like it probably worked in the 1920s. I'm not saying it works now, but it's just an interesting psychological story. A young man goes to a veteran Wall Street trader and he says, everyone is buying cotton, or everyone's buying this stock, and the guy says he sells 100 shares of the stock, and the guy who gave him the tip said, "What are you talking about? Sell? I said buy. Everyone's buying the stock. It's going up." And he kept on selling more, and then he ended up buying a lot. But he said the reason I sold is to see, are other people buying? Because if I sell and the price goes down, that indicates that there's no one buying. But if I sell and the price stays where it is, that means someone's buying on the other side, and that you're right, that you're not lying to me. And yeah, I mean, I don't consider myself a trader or have any insight on, most of the content I consume and content I create is not about trading, but I mean that, people trade every day, and it's very important. And it's a wonderful book that I really recommend.
Excellent. Yeah, behavioral finance, absolutely at the core of being able to understand how markets move and why they move. Give us number 4, Jack.
All right. So I'll first say, like, every book by Adam Tooze is really good. I haven't interviewed him, but let's see what we got here. Shutdown, The Deluge, Crashed is actually probably his most well-known book. My favorite would be Wages of Destruction, about a very dark topic, the Nazi war economy. But it is extremely detailed and one of the most interesting historical books I've ever read. Someone who I have interviewed, Bethany McLean, author of the famous Smartest Guys in the Room about Enron. I also enjoy her book about fracking, which I forget. Her book about Fannie Mae is very good as well. Just look this up. And then my personal favorite is about the formation of the Great Financial Crisis. All the Devils Are Here. I'm going to start throwing out a few curveballs. New York 2140 by the science fiction writer Kim Stanley Robinson is about New York in the year 2140. Basically, much of the world has flooded due to climate change, but financial markets are still thriving. And there's basically there's a real estate bubble in submerged properties, because this physicist created some mathematical equation on how to value real estate that's underwater, and people live in I think real estate that's underwater, and basically there's this huge property bubble and it burst. So it's kind of like 2008, but it's it's in New York. It's fun and very interesting. He's if you're into sci-fi, he's the guy who wrote the Mars trilogy, which is pretty well respected. Devil Take the Hindmost by Edward Chancellor. I interviewed him alongside Joseph Wang about his new book, Price of Time. Roger Lowenstein's great. I recommend everything he's read. I interviewed him about Ways and Means, about the financing of the Civil War. What I'm reading now, and I'm almost done, honestly, is by Barry Eichengreen, economist, who actually wrote the paper about debt sustainability for the most recent Jackson Hall of Mirrors. It compares 2008 to the Great Depression, and basically it shows that the 2008 Great Financial Crisis and the corresponding recession really was nothing compared to the Great Depression in the States. There are places of Europe, such as Greece, where the financial crisis and economic slowdown and recession really was worse than the Great Depression, which is interesting. But I actually find I think Americans don't like Americans don't understand just how bad the European economy was, and it arguably still is, and how maybe like there kind of was a huge credit and currency bubble with the foundation of the euro that still is in the process. I mean, like, look, like inflation is very high in Europe, and the unemployment rate is high. It's like it's just a less good economy, and I think that people should be aware of that. And I mean that's why like all these European stocks have a PE of 5. It's like because it's not a great economy, and that could change tomorrow. And I'm not saying that what has been the case will continue to be, but yeah. So Hall of Mirrors by Barry Eichengreen. I think
And
that's everything I wrote down.
Let me just give a special mention for When Genius Failed.
Yep.
That is one of my favorite books of all time about LTCM, but not just about LTCM. It's about how Wall Street thinks about derivatives themselves and why derivatives are so prevalent in the system today. That is a fantastic read. And then for Eichengreen, we're talking about one of the world's experts in financial history,
yes,
and in currency at large. And Eichengreen's name is all over every single thing that I read all the time.
Yeah, he's a giant.
He is a giant. Jack Farley, we are so appreciative of your time. Thank you for sharing so many reads. We are going to have a lot of work for ourselves in editing so that we can have all these book covers on the screen for you guys for our YouTube channel. Make sure to subscribe to us. Subscribe to Jack's show. Jack, tell people where they can find your excellent podcast, please.
Thank you. So my show's on Spotify and Apple and all the other podcast apps as Forward Guidance. And Forward Guidance is also on YouTube under the channel Blockworks Macro. That's the name of the channel. And then I also post the videos on my personal Twitter. My handle on Twitter is Jack Farley 96. Nick, I've got one question for you. When are we going to 100,000 in Bitcoin?
We are probably heading there over the next several months. And the way that I'm thinking about this bull market is that it is going to go into 6 figures and much higher by the time that 2025 is over. So we are in the beginning stages of a big Bitcoin bull market. To time it is just not my cup of tea.
But it's no one's cup of tea. Let's be honest. No one
Yeah.
knows what, if something's going up, down tomorrow or next week. But I do think that Bitcoin and like the correlation between Bitcoin and stocks, S&P 500 or the NASDAQ is very, very high. And I think that probably Bitcoin, will continue to have a return profile that is somewhat similar to like a triple levered NASDAQ position. So yeah, if the S&P 500 is at 6,000 by the summer, not my projection. Like I would be surprised if Bitcoin's not marginally higher. Likewise, if S&P is at 4,000, I'd be surprised if Bitcoin's not marginally lower. So, there are a few things that you can say with the confidence higher than 51%. And I think one of those is kind of obvious, but yeah, Bitcoin and stocks are pretty correlated.
And without a doubt, the correlation is strong between Bitcoin and stocks, but I would put a nuance in there in that correlation does not mean return profiles will be similar in the short, medium, or long term. So Bitcoin and stocks could be 90% correlated, but Bitcoin could go up 200% and the NASDAQ could go down 2%. So it mathematically, those things are still both possible if the movements are correlated
on the same time horizon.
Yes.
Okay, explain that.
Okay, so the reason that can happen is, say NASDAQ goes up and the NASDAQ and Bitcoin go directionally the same way every single day.
Mm-hmm.
So on a daily basis, they will be highly correlated. Okay. But the magnitude of move on the upside days for Bitcoin could be so outsized that a choppy stock market and a Bitcoin raging bull market could happen at the same time. the assets could still be correlated, but the returns could diverge enormously. Empirically, we've seen that as the case in past Bitcoin rallies, in that it still keeps some correlation to stocks, but then it can have periods where for a few days or for a few weeks, it'll drop correlation entirely, go into some manic frenzy, which Bitcoin tends to do. And so my base case is that for that to happen again, for periods of time, short periods of time, they will decorrelate or even have less correlation, but just in Bitcoin's really explosive moves higher. And it'll still tick with the NASDAQ on days where, NASDAQ goes down, Bitcoin goes down, NASDAQ goes up, Bitcoin goes up. So I think those two things can actually coexist, and I believe that they will.
So Nick, I think everything you said is true, with one caveat, which is the question I said is on the same time horizon. So if Bitcoin goes up on the same day and the NASDAQ goes up, on a 1 day time horizon, it's a correlation of 1. And if it does that 5 days in a row, it's a correlation of 1. But I think that if you roll it, and you have to choose the periodicity of how long your like sample period is. So I think like if you're sampling over 90 days and the correlation is positive between Bitcoin and the NASDAQ, I think after 90 days, if the NASDAQ is up, Bitcoin should be up. Like I think the huge discrepancy that you're just describing is like it can be explained if you're only doing a sample for very small correlations. And I think when you're making a graph and you're doing a 5-day correlation, that doesn't mean anything. I think you got to do 90 days, 120 days, 200 days if you get greedy.
Absolutely. We look at 40-day. That's one of the ones that we use at the Bitcoin layer. But listen, the breaking down the math is something that we can do in a full research post. We can look at that. What we have seen empirically, the study that we've done at the Bitcoin layer, is that looking at 40-day correlations between the Bitcoin and the S&P 500, we see periods of relatively high correlation with flat stocks and enormous Bitcoin performance. So those two things can coexist mathematically, even if you have, and that's because the correlation isn't 100%. So you have days where there's material divergence, and that divergence gets so material from a Bitcoin perspective that you get these periods of outperformance. And that's why Bitcoin is up, millions of percent over a decade, the last decade, is because it's the only asset to exhibit this type of very unique behavior. And it's part of what makes it so exciting. And we are always challenging ourselves to do better. Nobody knows it all. And that's why I love this job. I get to ask people questions, continue to work on my research and the data that we're crunching through.
Yeah, well, I'll take your word for it. I'd love to look at your research. But would you agree with this? So just because they have a positive correlation doesn't mean that the return profiles are going to be the same or even similar. However, if both are up, a tremendous amount on, if you're having days and days in a row where they're both very correlated and they both go up or go down together, the correlation will be there, right? It will be positive.
Yes, definitely.
You're just saying it's not just because it's positive doesn't mean that they're going to go up and down together.
What I'm trying to tell people is that I agree Bitcoin and the stock market are correlated. That is absolutely true. I agree that. However, Bitcoin going to 100,000 and beyond does not depend on an equity bull market or favorable financial conditions for equities. I don't believe that.
Okay.
I do believe that in a risk-off time, Bitcoin will sell off with the stock market. I believe that too. So I can believe all of these things at the same time. And that's basically what I'm trying to just explain to people is that, yes, look at the last week or two, stocks have dumped, Bitcoin has dumped, risk has been off as yields have gone higher, the dollar has gone higher. all markets go, the correlations go to one, as they say in crises. I believe all of that. I understand all of that as well. So I'm not discounting that at all. It's really this idea that I genuinely don't believe that $300,000 Bitcoin is dependent on another year plus rally in all stocks and easy financial conditions.
This you're secular bull. It's like if I'm a huge secular bull on Visa, the stock ticker V, and I think it's just going to crush the S&P. Obviously, when the S&P is down 5% in a week, it's very likely Visa is going to be down too. But I just think long term, it's going to crush the stock market, and that sounds like that's your view.
Yeah, and even with Visa, it's still dependent on. It's just naturally going to be correlated with other companies. The Bitcoin, I believe, has enough of its own fundamental demand that it exhibits characteristics from the demand side that vary from stocks in a material way, even though they are both beneficiaries of marginal liquidity, because they're both easily accessible financial instruments, tradable financial instruments. So hence the correlation. And if you want to get technical about the correlation is there because they are in the same algos. I mean, full stop. The reason that they tick is because there is an algo out there, or hundreds or thousands or even millions of them, that buy Bitcoin and stocks at the same time when the AI or the algo is making its decision or its pre-programmed choice. So that is why they tick together, because they're being bought together by hedge funds and algos. Mathematically speaking, that's also the case. So all these factors are there. It's a fascinating asset class to watch, and the Bitcoin layer is definitely here to be on the cutting edge of these interesting Bitcoin and global macro topics.
Definitely. Well, you're a very interesting thinker, Nick, and I'm glad that we met.
Absolutely. Jack Farley, thanks for joining us at the Bitcoin layer, and we'll catch you guys next time.
Thanks. Talk soon.
Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.